We'll see. Hey, welcome back, everyone, to the Black Brain Trust. This is episode 184. I'm here with my co-facilitator, Lionel.
Hello, hello everyone. How you all doing today? How you doing today, Mike?
I'm good, brother. Yourself?
I am well.
All right. Please hit the like button as you come in. Share the video if possible. Just as an FYI, we are not certified financial planners. If you want a CFP, go to CFP.net and look up one in your area. And there's a docket in the description beneath the video. You can use that to follow along, and we will get started. Just Be You TV, how are you doing? Welcome. Complex Design, what's going on, brother? Reigning Woman, how are you doing? Good evening. All right, so first item on the docket. This one is from fastcompany.com. Those in power need to stop using black women as props. Too often in the worlds of politics and tech, black women are used to cover up a lack of diversity. I wasn't raised to be a token, and I want others to learn the same. My grandmother had a saying for when I used to complain about something. Well, black folks, especially black women, are the mules of the world. We work full time jobs, are full time mothers, and are full time caretakers of the community. We are the original beasts of burden. I don't think I fully understood what those words meant until I took stock of my place in the tech world and watched the recent House Judiciary hearing on hate crimes and the spread of white identity ideology. When I juxtaposed my experience in tech as an attorney and an advocate with that of the uh, cavalcade of black folks sent to testify in U.S. Congress on the state of white supremacy, anti Semitism, and censorship on social media platforms, and realized it was also that time of the year when companies release their annual reports on the diversity of their workforces. My grandmother's words echoed in my ear. It's always interesting to see who each organization and company needs needs to these hearings or sends to these hearings to articulate its efforts and intentions. I noticed that Facebook and Google sent mid-level black attorneys to address their efforts to limit toxic content on their platforms instead of a vice president or C-level C-suite level executive. And one curious inclusion was Candace Owens, a Republican activist who had turned into a media darling for being a black woman who uses social media to expose or espouse the the far right gospel and who briefly converted Kanye West to her version of free thinking. At the hearing, a patent emerged. Owens was invited to testify by Representative Louis Gomert. He he began his introductory remarks at a session intended to discuss the prevalence of white supremacy on platforms by quoting a portion of Martin Luther King Jr.'s often cited out of context "I Have a Dream" speech, and then Gomert claimed that his good friends, Fox News favorites Diamond and Silk, were being censored on Facebook as he pivoted to decry the perceived conservative bias on the platforms. The episodes the episode echoed a moment in February during a House Oversight Committee hearing featuring testimony by Trump's former lawyer Michael Cohen regarding a penalty of president's alleged indiscretions when Lynn Patton, a housing and urban development appointee who previously served as a wedding planner for the Trump children, was presented by Representative Mark Meadows as a living, breathing rebuttal of Cohen's claim that Trump is a racist. However, during the exchange, Patton stood there quiet and expressionless, simply symbiotic. It was deemed a prop by freshman representative from Detroit, Rashida Tlaib. This is this is interesting in the event of doing business. One of the things that I find interesting is that we have always talked about this as black people, as black men, I should say. And one of the one of the aspects about hiring black people is that they always go after a woman, after black women, because one, she's black, and two, she's a woman. A lot of the times when those black women get into these corporate spaces, they are okay with, you know, being a part of that corporate fraternity. And then they turn back and look at black men and say, "Oh, well, how come you black men aren't, doing this, this, and that?" Well, that's because you've taken up all the jobs because you're filling up the affirmative action quota. Well, now you don't like being used as a token, according to you. But the reality here is that you enjoyed your place in those corporate fraternities. You enjoyed those privileges. Now you don't want to be used for that, according to the article. But you can't blame anybody else other than your collective of sisters who partake in these sort of hirings and job placement.
I was triggered at the
Hmm.
first beginning of the article, and I'm glad I was muted. The person said her grandmother told her the black women are three things: they work full time, they are single parents full time, and they are the keepers of the community. How on earth can you do all three of those at the same time?
Mm.
You're gonna work, parent full time, and keep control of the community.
Hmm.
So by that logic, you're saying you do all these things and black men can't do any of those things. That's a twisted thought just coming into the article, just thinking about yourself on a day to day realistic basis. If you think of yourself in those terms, then you are already set back.
Hmm.
So when you get these, as BGS say, butter biscuits, you are, and I agree with you on this, going to turn around, look at black men and say you're not doing nothing because you think of yourself this way.
Hmm.
So now you're going to look at black men and say, well, this and you're not doing this, you're dusty, you're beta, those type of things.
True.
So now you are saying, well, we don't want to be these people lacking in terms of the job structure, the clubhouse, the C-suite, or the everyday job clubhouse. But I agree with you. You like them. I haven't I haven't worked in the corporate world, but anecdotally speaking, from so many people I've spoken to, know of, and even the people from the Brain Trust, they absolutely love these quirks, and not quirks, but these tokens and these favors that they get.
Hmm.
So what's so you think of yourself as these super women, and you have these jobs that you're getting.
Hmm.
So what's the problem? I don't understand.
Well, they don't. It's sort of like phantom power. You think that you know you think you have all the strength, but in reality you really don't. Um, so they got advantage of all this privilege, but at the same time they got into this certain space with there was supposed to be this imaginary power that doesn't really exist. And unfortunately, that becomes a rude awakening because you're just a puppet. You're realizing that you're just a puppet.
Yeah. Now, I don't mind
Hmm.
them receiving these positions.
Hmm.
And I want to say, please hit the like button as you come in. I got 17 people watching, only 10 likes. But to then turn around and criticize black men,
Right.
That's where I have a problem at. Yes,
Hmm.
be a part of this corporate world and be and do the things, those three things, including more that the person just said in the first beginning of the article, together with black men,
Hmm.
because that's all you hear about them. That's all you hear from them saying.
Hmm.
But don't turn around and say, "I got this, and you're lesser than me." That's the hang up. That's the misconstrued thought. That's the disconnect right there.
Yeah, absolutely. Let me get to this next article. All right, this one is from entrepreneur.com. To succeed at business, you need a startup mindset. Startups are born to scale. They are created to search for and validate a scalable business model in a way that can have a major impact on the market or how a problem has traditionally been solved. The innovation, disruption, and scalability aspects of a startup are why they are different from small businesses, and more importantly, why they can't be treated or built as a small business or subversion of of a larger on a large company. Small businesses are created to generate profits and secure local market share. Although small businesses also have the potential to grow into large companies, the driving force behind their growth is national and international expansion through larger teams, supply, manufacturing, and distribution channels. When WhatsApp was acquired for more than $19 billion, it only had 55 employees. Instagram, YouTube, Viber, Skype, and Tumblr had 13, 65, 50, 911, and 178 employees. Respectively, technology is an enabler, and the reason startups can scale so quickly with a repeatable business model and a tiny user to employee ratio, unlike small businesses. For example, certified public accountants, CPAs, run a small business, and the core of their service is provided by them or their team. Although technology helps them do their job or save time on repetitive tasks, they cannot serve a client without investing time to review and complete their tax returns. On the other hand, startups like TurboTax have created a scalable platform that enable them to serve hundreds of thousands of people without needing the same number of service providers. A scalable business model powered by technology enabled this startup to grow exponentially at a pace a small or medium business cannot match without investing a lot of resources. Scalability, innovation, and disruption come at a high cost. While around 50% of the small businesses fail in the first 4 years, 90% of the startups don't make it, and for those that do, several encounter near death experiences along the way, according to a startup genome study. Thankfully, several startup and product development methodologies have been introduced to provide entrepreneurs with frameworks to alleviate risk of failure and boost startup success predictability while minimizing costs, whether it's time or money. Many of those practices can also be applied to start and grow small businesses. Here are two ways a startup development mindset can help you start small businesses on stronger foundations. Leverage existing resources. As opposed to small businesses, which typically execute on proven models, startups are created to search for a repeatable and scalable business model. As such, in following the dot-com crisis that resulted in massive uh, failures, uh, failures due to startups investing hundreds of millions of dollars under the assumption that the business or that their business models are validated, several principles were introduced to help startups alleviate risk, validate ideas quickly, and build in response to demand instead of based on inaccurate projections. The lean and agile development methodologies entail implementing an iterative process that starts by validating customer needs and expectations qualitatively through interviews, followed by small and quick product version launches to test quantitatively and continuously instead of investing significant amounts of time and money building an advanced product, risking that no one needed or want to use it the way it was originally hypothesized. Sell first, build next. It is often believed that a product must be good or unique enough for a business to exist. The truth is, the entrepreneurs pour blood, sweat, and tears into build build to perfection today is often mediocre when evaluated a few months later. The idea of building a perfect version of a product or service before offering it for purchase is flawed. By combining the lean principles shared above founders and with pre-sales, founders can significantly minimize business risk once they build once they will build in response to demand with higher certainty. While the product may later fail to meet buyer expectations, its value can be validated quickly with financial commitments. Researchers and consultants Hatami and Candice Lund Plockton and Mashira found that companies that pre-sell their products achieve above average customer acquisition and retention rates of 40 to 50% and 80 to 90% respectively. No matter the product, several marketing campaigns can help you execute a pre-sale strategy. However, since you are selling a promise, prospects will be investing in you, therefore personally meeting your ideal buyers. Showing your passion and seriousness in addition to the samples or a prototype is how you will be most effective in pre-selling your idea. This is actually really bang on the money. As someone who's worked in startups and stuff like that before, they are really bang on the money about how this has to go. Um,
Oh, are you there?
yeah, I mean, I just got
Okay.
I canceled out one of the windows, but I was just making a point that the methodologies that they're talking about is actually real. I've talked about this before in the Hangout. You have to make sure that what you're doing is actually going to meet the the needs of the client or the customer, right? You can't just say, well, let's start a business on Monday and let's just get some shit started. That you have to really walk yourself through the methodology to understand, can I answer all of the questions that are going to be answered, I mean, or going to be asked to me? If you don't have an answer, then you're gonna have to go back to the drawing board and start from scratch, or start from a point where you did fail to meet that question with an answer. Um, One of the things that we figured out in the tech industry is that um, these long, drawn out processes that traditional businesses work off of, those models don't really work in the startup space. In the startup space, it's you have to put the vision on the board to understand the mission. The vision comes before the mission. The mission um, is the precursor to the actual to the actual goal. Um, Once you lay all your chips on the table, you have to actually mark them down as to what it is each and every chip or each and every milestone is met. So if I have five chips on the table or five milestones on the table, each milestone needs to have a definitive area of achievement. What are we achieving with this? Let's use the brain trust for example. When we started the brain trust, it was just technology, geopolitics, and economics. Space came after that because and space was separate from technology. It wasn't until the next go around that we decided to add space and technology as one on Monday. So therefore, we combined two products or two areas of two genres into one to satisfy the customer, which is the viewers here. So we kind of, at least that's kind of how we ran the our channel. We ran it like a startup. We ran very lean. We didn't have the best microphones. We didn't have the best presentation. But as we got feedback from the customer, which is the subscriber, we went back and made those changes, and now we have a better product. So,
Okay, so the article, 'cause I'm trying to wrap my mind around this also. So the
mhm,
article is saying, I know you just mentioned run lean in the beginning. Obviously, everything is not going to be perfect from the get go.
mhm,
So, but from the get go, you need to understand what you're starting out with. You need to understand what it is and how you can convey that or articulate that to people who ask you questions.
mhm,
And like you said, if you can't ask the question, you have to go back to the drawing board to be able to answer that question and any other questions that may come from that.
mhm.
So as you go on, you add more things, add more ingredients into the pot that will expand the business and make it. I don't think I'm saying that right though.
Well, we listen to customer demand, right? So customer being subscriber said, or a subscriber or viewer said, maybe it would be cool if we did it this way. It would be cool if we had it this way. But then we also looked at it and said, what if we included space and technology on Mondays, right? And that worked out for the best. So now we freed up Saturday to add another product, which is Black Tech Talk or Black Business Talk on Saturday, something that's more narrow and focused, right? So it's not so broad.
I
And
see what you're
then
saying.
and then we added and then we filled up the Sunday slot for business wealth and power is cannabis discussion. So we've run the brain trust just like a startup. So a lot. I mean, I mean, it's not profit, but it still ran like a startup. It still gets evaluated, or the docket gets evaluated before it even goes up, and we can change on the fly because that's the part of the methodology of a startup, of a lean and agile startup.
So when
and
you be,
we and we
oh, go ahead.
leverage and we leverage the infrastructure that's available, which is YouTube, for streaming. But
So in the beginning, run lean in the beginning, but as time goes on, as you get feedback and evaluate that feedback, you build out from there.
exactly,
Okay.
when you run lean, you're um,
Beholden.
not so much beholden, but um, you're not investing too much. So if let's say, for example, lean would mean that instead of us putting thousands of dollars into the channel, we only have to put in, let's say, $100, but we also broke the $100 across 8 different members of the brain trust. So therefore, we only have to put in $12 a piece, right? Or
Right, right.
$13 a piece, or whatever it is. So that's what they mean by running lean. So therefore, we're not coming out of our pocket very heavily, running a lot more lean. So
Okay.
it's an interesting article. It's definitely something that it's definitely something that people should pay attention to, of how startups are actually run. I came from, Complex worked in the startup sector. I've worked in the startup sector. Um, I've seen how it's run. Complex seen how it's been run on his end. Uh, you can see various startups in the tech community right now, especially in micro transportation, bird scooters. I think there's like maybe a couple of dozen people there, maybe less than 50, who are in the corporate office, and then you have contractors on the outside doing all the tooling and mechanics of the product itself. Although those contractors are not dedicated FTEs, which is a full-time employee, they're still a part of um, the major operations that happen for the company itself. Because Bird, like the article says, it runs lean and it uses existing infrastructure, so they don't actually manufacture the scooter. They actually buy the scooter and then they brand it and they add their own um, their own items to the device itself. So there's a whole lot of things that comes out of this.
Yeah, that sounds interesting.
Yep.
Yeah, that article does sound interesting.
Yep, you got to read it a few times, man. It's pretty good. All right, next one is from investing.com. Boeing Q1 earnings may not offer relief, but long-term view remains rosy. Boeing is still reeling from one of the worst crises in its corporate history after two fatal crashes involving its best-selling plane. But the American aviation giant will get another chance next week to calm wary investors when it releases first quarter earnings on Wednesday, April 24th, which just passed. Shareholders will want to know what impact the worldwide groundings of its 737 MAX jetliner has had on the company's earnings momentum and long-term growth plans after the two deadly crashes within 5 months forced the company to cut its 737 production by 19% and form a committee to review the design and development of its aircraft. The stakes are high for both Boeing and for the U.S. economy. The 737, which first entered service in the late 1960s, is the aviation industry's best-selling model and Boeing's top earner. The re-engineered MAX version was so successful it attracted over 5,000 orders worth more than $600 billion, including planes that have already been delivered, according to Bloomberg data. Deposits from 737 MAX orders helped boost Boeing's revenue from $100 billion for the first time last year. The, that drove the Chicago-based company's market cap to over $250 billion before the Ethiopian Airlines crashed last month, the second after October's fatal incident that also involved the 737 MAX operated by Indonesia's Lion Air. 737 MAX is Boeing's largest contributor of product revenue and earnings before the interest and taxes. According to Goldman Sachs estimates, with the potential to mark up 45% of Boeing's earnings before interest and taxes over the next 5 years. So this is just a chart showing some of the candlesticks involved in Boeing stock and what it was trading on for the yearly.
Hello, Dollar Will. How are you doing today?
Is Dollar on the panel?
Yeah, there you go.
Hey, what's going on, Dollar?
We can't hear you, Dollar Will. Can you hear us? I don't know. I think you may be having mic problems. But my 2 cents about this article is, yes, what DE broke down the situation with Boeing and 737. It's those two fatal crane um, um, accidents. He broke that down. My view on Boeing
Hello,
for the
can you guys
future.
hear me?
We can
Hello,
hear
hey,
you
what's going on? How you doing?
Good. Good. I'm sorry about
Yeah.
that. Go for it, fellas.
My view on Boeing for the future is we know that Boeing and SpaceX is not competing with each other, but are delivering payloads to the ISS via NASA and any other. Um, well, well, they are in the space exploration, not space race, but space exploration for the American government. You have NASA, not NASA, but Boeing and SpaceX in a particular category. That space exploration can really bring more, can really raise Boeing stock in the future. That's my view of what that article was pointing out in the long term. You go ahead, Delaware. I'm done.
I'm sorry, fellas. I didn't really catch all of that article, so I'll sit this one out. I was kind of trying to peek at the chart while you guys were talking about it just now. S Sorry about that.
Oh, that's fine. Let us know when you're ready.
So what is it you wanted to what carry on? I'll catch up to the
All right,
next one.
all right, all right, all right. This next one is from Axios.com. Uber raises $1 billion for its self-driving unit. Uber on Thursday night confirmed that it has raised $1 billion for its autonomous driving unit at a post-money valuation of $7.25 billion. Why it matters. Uber is preparing to go public next month, and the deal could soothe some investor concerns about the cash burn on self-driving research and development. Existing Uber shareholders SoftBank Vision Fund and Toyota were joined by Japanese auto parts maker Denso. Toyota and Denso will invest a combined $667 million, with SoftBank's Vision Fund putting in the rest. The, the self-driving unit will form an 8-person board of directors that will be comprised of 6 Uber-appointed members, one from SoftBank and one from Toyota. Its employees will continue to be compensated with Uber stock. Toyota is also committing up to an additional $300 million over the next 3 years to deploy autonomous vehicles into the Uber's networks by Uber's network by 2021. SoftBank last year made a similar investment into General Motors' self-driving car unit Cruise. Um, what's your take on this, Lino? Or anybody wants to jump in on this? Uber raises $1 billion for a self-driving unit. I see this as a big positive. That means that they're going full steam ahead.
Yeah, it's a very big positive. They were just Uber just hit their IPO, right? If I'm not
Mm.
mistaken.
No, that
So
was Lyft. I think that was
that was
Lyft.
Lyft. Okay, so I think 2 weeks ago we covered how Uber purchased Kareem, the Saudi. That was a Saudi drive hailing service for the Middle East. Now you have this. It seems like, and even then when they purchased Kareem, we were talking about how they were beefing up their IPO um, allure. Now they're investing into self-driving vehicles. That's even more alluring to people that want to invest in um, Uber's IPO or just stock long term. It's showing to me, it's showing that they are investing into the future. It's showing to me that they have a finger on the pulse of what the future is going to be. They're branching out. They're investing in future technologies, this fourth industrial revolution, technologies that are part of the fourth industrial revolution. It may not hold so well to people that drive for them, but that is what I think about it right now.
Mm.
Yeah, I think I'm a little suspicious of it as um past shows I mentioned. This is you have to go back several months. I explained about the cycle, what happens when you at the end of a long bull run like this. Companies that's a good time to go private. Remember the purpose for a company going I'm sorry, going public. The purpose for a company going public is to raise money.
Mm.
Once you have a stock offering, and you these guys become like billionaires overnight.
Mm.
So that's the primary reason for it. And so, what better time to go public than when we're fat and happy at what I really firmly believe is the end of a bull run. So the tell will be how long um, those people coming in right now, investing right now. And the article said that Uber is going to have they're going to go public next month, so they're going to follow Lyft and they're going to have an IPO next month. The question will be, how long do those people hold those shares? Now, this is a question I have for Paul. I'm not sure if Paul is around. Is there any obligation, requirement that those early investors like that hold their shares for a certain amount of time? That I do not know.
I think
That's
it
a question.
depends on the investment round that they invest in.
Okay.
Because if you dump, if you dump as soon as the IPO happens, then yes, the price is going to tank. If you invested early,
Hmm.
then I believe it. Yeah, Paul will have more knowledge about this, but I think it depends on which round you invested in.
Right, because this stock, this thing, this, as you see in a lot of these IPOs, the price could shoot up really, really fast, you know. And so for some, if there's no um obligation, no hurdle uh to selling, I mean, you could, this thing, it would be nothing for the price to go up 50% or something in a day. Remember, these are investors. They're in it to make money. Everybody's in it to make money. So if you see your investment go up like, 30, 40, 50%, why, if that's going to be the tell. Do people hold on, especially a month from now? Let's say if the market is declining, it's going to be interesting. So for me, it just depends on your overall. I think, with all of these things, you have to look at the overall marketplace. But in the long run, I mean, Uber's going to be around, Lyft is going to be around. So
Yeah, but in what capacity will they be around? So that's the real question for the long term. What capacity will they be around? Whoever is the first to get to market with an autonomous ride sharing vehicle will be the ones who stock goes right through the freaking roof.
yeah, yeah. But either, yeah, I think there's room for both. No matter, so that's to say, whoever's second to market with autonomous vehicles, I think that company will still have a place,
You said
and
first
there's
or
a
second?
need. Hmm?
You said first or second?
I'm saying even the second place one. I think it's a case of win big and win. One is going to win more, but I think both will win. I don't think there'll be a loser. You know what I'm saying? I think they both will make money, and and both stocks will rise. I mean, because the way the market sometimes they'll look at, let's say Uber is, let's say Lyft is first with autonomous vehicles, and the price goes up for Lyft. Well, people, sometimes the market may look at Uber and say, okay, well, Uber is going to be next, and their stock is a bargain right now. So it's good news in either company will help both.
Hmm.
One more than the other, but both. I don't think there'll be a loser between the two.
Hmm. All right, this next one is from CNBC.com. Apple spends more than $30 million on Amazon's clouds every month, making it one of the biggest AWS customers. As Apple and Amazon compete for greater share of consumer dollars and attention, they also have a particular intimate business relationship. Apple is spending more than $30 billion a month on Amazon's cloud, according to people familiar with the arrangement. Apple's cloud expenditure reflects the company's determination to deliver online services like iCloud quickly and reliably, even if it must depend on a rival to do so. As Apple's top product, the iPhone, approaches market saturation, the company has begun pointing out to online services like a key contributor. Recently, the company stopped disclosing unit sales for iPhones and other hardware products and started disclosing the profit margin for its services business, which includes iOS App Store, Apple Care, Apple Pay, and iCloud. Apple also introduced new subscription services for video and magazines last month. People use more than 1 billion Apple devices each month, and accordingly, Apple has considerable computing and storage requirements. The company is investing heavily to build its own infrastructure. In January 2018, Apple announced plans to spend $10 billion on data centers in the U.S. within 5 years. In December, Apple said it would spend $4.5 billion of that amount through 2019. The company also depends on smaller third party cloud providers, but it also relies on big cloud providers, including Amazon Web Services and Alphabet subsidiary Google. Microsoft has also provided cloud tools to Apple in the past. The company has said in the past that it was using AWS for iCloud storage, but has not disclosed whether any other Apple services use AWS or other third-party clouds. So this is interesting because um, not that it's a bad thing, but it's a interesting piece to note because Apple doesn't have its own cloud platform, despite the fact that it says iCloud. They really don't have their own, or at least previously they did not have their own proprietary data centers. You would think a company like Apple would actually do that. So,
Mm. And that's a big expenditure from a company whose revenue is comes 70% from the iPhone, and iPhone sales are slowing down.
mhm,
Now, as we see, they have the Apple streaming service that is going to bring in new revenue. And if they can get that $30 billion down a year
mhm,
down just for paying for cloud services, which Amazon AWS is the 800-pound gorilla in this arena, in the cloud arena. But you have upcomers such as Microsoft Azure. If they can get, and as the article pointed out, Apple is building their own um, data centers in the U.S. But if they can get that $30 billion down, then that will free that money up to do other things on top of them doing something about their hardware product line.
mhm.
Um, that's a large expenditure, and I do clap my hands at Apple. I say kudos to Apple for building out that data center infrastructure, not just sitting back and just paying that $30 billion a year, because that can go up. That can go up.
Mhm. Dollar, will you have anything to add to that?
Yeah, it's just amazing how powerful Amazon is. They're the mightiest retailer in America, if not the world, and they are, I guess, all things cloud and data storage for the internet. So that's a they. I think Amazon is at some point going to have to break that company up.
Well, it's already broken up, and it's not. So Amazon Web Services is different from Amazon itself. They're a subsidiary.
Okay, does it trade under its own symbol, or is it
I,
private?
I don't think so. I think it's under just the Amazon symbol itself, but um it's just like a subsidiary service of Amazon. But they could spin off and be their own thing. But I'll cover it tomorrow on the IT summit
Okay.
in detail as to why they're going to run into some headroom, some scalability issues. So.
Yeah, because I mean, even just from the standpoint of an investor, when you're looking at, for especially the fundamental crowd,
Mhm.
they're gonna want to at some point want to see get some clarity on the retail versus the data business, the server, the iCloud business, and because retail is gonna go through a lot of pains as when this market falls. Retail is gonna hurt,
Mhm.
probably hurt, likely gonna hurt more than the tech side. So it could end up. Just kind of keep your eye out, your ear out. You're likely to hear investors want to separate that out because people might not want the ugly retail numbers to make the tech numbers look worse. you know.
Let me address this in the chat. Sean says, sounds like more IT jobs on the market provided by Apple. Not exactly. So A- Apple is, the whole purpose of using cloud is for automation and leveraging other people's resources. So Apple has its own internal division that actually does all of their automation of tools and services like iCloud and all that stuff. So all they're doing is they're porting it through an API and then they're pushing it over. The other side of that coin is that people who work for AWS will have a full time job. You won't be an LTE, you will be an FTE, a full time employee. But the point I'm making here is that Apple is just leveraging whatever resources is available because they don't have their own. And usually, if you don't have your own, they don't consider you a they don't consider you an alpha in the tech industry. You're not an alpha unless you have your own. So let me get to this next article. All right, this one is from NPR. Kohl's will now accept Amazon returns at all its stores. Buy something on Amazon and want to send it back, Kohl's will take it off your hands for you. The department store chain announced Wednesday that starting in July, it will accept Amazon returns at all of its 1,150 stores. Kohl's says it will accept eligible Amazon items without a box or label and return them for customers for free. The program will expand a pilot introduced at Kohl's stores in Los Angeles, Chicago, and Milwaukee markets in 2017. The move in the move highlights a major headache for of online shopping online. You often can't try something before you buy it, and if the item doesn't work out, it can be a hassle to return it. The Kohl's Amazon partnership offers one solution, at least for the people with a Kohl's nearby. Kohl's stores are often located in suburban strip malls, no city centers, so the partnership won't help many carless urbanites. And why might Kohl's want to partner with its online competitor? Foot traffic and new customers. If Amazon shoppers go to Kohl's to make a return, perhaps they'll pick up a few items while they're at it. Michelle Gass, Kohl's chief executive officer, said in a statement that the new service is another example of how Kohl's is delivering innovation to drive traffic to our stores and bring more relevance to our customers. Data firm Ernest Research found that a few months after Kohl's stores in the Chicago area introduced Amazon returns in the pilot, revenue growth at Chicago stores began outpacing the rest of the U.S. and sales, transactions, and customers growth rose too. Shares of Kohl's stock spiked on Tuesday with the news of the Amazon returns program, and analysts thought the move was a shrewd one. Better to be swimming alongside than in front of the shark, said analysts at City Research, as the Associated Press reported. Jeffries and Jeffries analyst Randall Koenig agreed in a research note cited by CNBC. Growth in the growth in this partnership illustrates to us that stores are needed even as online shopping becomes increasingly pervasive. He wrote. Amazon has already gone brick and mortar with its own bookstores and cashierless convenience stores, and moved into grocery space with its acquisition of Whole Foods, but it is still refining that strategy. Last month, the online behemoth said it would close all of its 87 pop-up retail kiosks that sold its smart speakers and tablets in malls, as well as Kohl's and Whole Foods. Interesting. Dollar Will, any opinion on this?
I think it's brilliant. I think that shows you why this guy is one of the smartest, I mean, one of the richest people in the world. You know, I mean, you can't, businesses of the past would not look for strategic partnerships like that. They would be so small minded, concerned about losing something as opposed to looking at what they have to gain. I think it's a win win. Smart for Kohl's,
Hmm.
smart for Amazon to think out the box. So you're not neither. No, people are not going to only shop online. You're always going to want to go to the store and get that last minute item or some things you want to see and touch, and try on. So it's a win for both.
This is happening in Lionel's backyard. What do you say about this, Lionel?
I agree. One of the ways you become wealthy is identify a problem and you exploit it. You offer a solution, and this is a solution. We already have to wait to receive whatever we purchase from Amazon, even if we have Prime, Amazon Prime.
Hmm.
Now you have to take it back. Well, let's go to Kohl's. Somebody may say, "Well, I'm gonna wait till Saturday or Friday or Saturday to go." They do it, and they exchange it. It says for free. They take it back. Um, that is something that's a niche that Kohl's is exploiting, and I agree with Dollar Will. It's brilliant.
But I bet you, Amazon better not have any supply issues because if if you can't find the item on Amazon and you go to Kohl's to return the item and it happened to be something that already is inside of Kohl's and instead of so you're returning it but you're not getting another one from Amazon, you're buying the product in Kohl's. So it's a nice option, but it's not. I can see a danger in it if Amazon has supply issues.
And that's also increasing foot traffic to Kohl's because once you
Right.
in the store, you may see something that, oh, that's nice, or women may say, well, as long as I'm in here, let me just look around because I've been looking for such and such.
Customers are always indecisive when there's too much choice. So you put them in somewhere like Kohl's, and as the article had stated, people are the numbers are showing that it's working. So it's just a matter of getting people out of the house and back into retail, brick and mortar. The funny thing is, you don't really see those sort of numbers reflected in supermarkets. Like people go into supermarkets, get what they want inside that little basket, and they're gone. Even to the point now where they're starting to order through Instacart, right? They kind of, I guess the mindset is different for for your everyday staples versus your consumer items that you will find in Kohl's and Target and so on and so forth. But yeah, anytime there's too many items, there's too much choice. They tend to be indecisive, so they tend to wander around.
I got a question.
Okay.
Do you think there's a what do you think the chance is the chance that Amazon is flirting with buying Kohl's?
No, I don't think they'll buy Kohl's, but what's happening now in the in this industry is that everyone's looking for a partner to survive. Amazon has a lot of expertise in automation and cloud computing, and a lot of these retailers do not have that sort of leverage of infrastructure and expertise. So there's a there for the both of them, right? Amazon gets to have a presence in the brick and mortar, and the brick and mortar gets to rely on infrastructure that they didn't have before. This is the it's a strategic partnership until it's no longer viable, unless some kind of market correction happens in the next few quarters. This is the way forward. Everybody has to partner with each other, whether they like each other or not. We just read an article about Apple and Amazon. These are two companies that typically don't even like each other. Bezos versus Steve Jobs when he was alive. Um, Two of those alpha males going at it. You know, they were competing. Now they're customers in that space. So
Out of the box thinking.
hmm All right, let me get to this next article. All right, this next one is from Bloomberg.com. Are we ready for the next recession? Theme of the week. It's been 10 years since the last recession, and the U.S. has managed to maintain a slow but steady recovery. But the next downturn can bring it all crashing down at any time. In a series of columns, Bloomberg opinions writer uh, are tackling the big question: when the next recession strikes, what can the world's central banks do? Oh, they took it away. Damn.
They changed the link on you and took the rest of the content away.
Yeah, because it did say I had 3 articles or 3 free articles remaining, and it just says 2 now. It's I don't know. I don't like Bloomberg. I'll just skip this one because I don't like to have a half-ass article.
Gave you a pitch count.
Yeah, give me blue balls more than anything. All right, this next one is from Engadget.com. Brave browser lets you see opt-in ads in exchange for rewards. Brave is moving forward with plans to pay people who view opt-in ads. Use the latest version of the desktop web browser. Sign up for Brave Rewards, and you'll have the option of viewing Brave ads that give you a 70% cut of the ad revenue through crypto tokens if you decide to click. They won't compromise your privacy, Brave said, and they'll soon be useful for more than just donating to sites and content creators. You'll have you'll have the option of redeeming them for real world rewards like gift cards and restaurant vouchers, and there are plans to convert the tokens into real currencies. The launch comes a few months after an early access program in January and has a few bigger supporters this time around. Vice and Home Chef are some of the partners supplying ads on top of existing allies like Tap Network, and which will also supply real world rewards. You should also see ads from charities and nonprofits like the Giving Block and the Human Rights Foundation. There, there's little doubt that Brave is being at least slightly optimistic. Its browser has a relatively tiny user base. It doesn't register on the net market shares usage charts, and advertisers might balk at a platform where users won't even see ads. Brave, however, isn't deterred. It notes it notes that people clicking the ads will be those who want to see something. And let's face it, the possibility of being paid for viewing web ads is alluring. Even if you only get a tiny reward each ad you view, that could quickly add up if you make a habit of watching ads on a regular basis. I hate ads personally. I don't mind if they're on the side of a screen, but when you interrupt my focal points or my focus for my screen, that really annoys the crap out of me. So I
Yeah.
don't care how much money you're paying me. I just can't stand it.
Also with YouTube now, those 5 second ads, they stacking two now. So then you gotta skip through two 5 second ads. But I use the Brave browser and it's helpful. They block a lot of ads. Um, that is one of the allures of Brave browser, and it's BAT token, and having the ability to pay people to look at ads that says 70%,
Mm,
people will go for that because if people in people's mind they'll say, well, if I'm on the internet, on YouTube, especially because of how big YouTube is becoming, I may as well get paid for looking at content I would otherwise look at. Now, with this, I understand it's good, which is good that you can then transfer your tokens that you receive from looking at ads to gift cards, or trade it for other cryptos, or even exchange them for fiat currency. That's good. That's great. But the process in doing that is not easy. On top of not too many people, A, know about your browser, and B, are using your browser. That compounds the situation. Now, that's not to say that that's the end all be all. Brave browser is done. And as time goes along, it will grow. But my thing is the ease in which people take the tokens that they're receiving from watching ads and cash out. That that process,
Hmm.
um, Brave browser needs to simplify that process.
Hmm.
Yeah, I think this slowdown, people really get pressed for money. I think we're gonna look back at that and say that's a genius marketing campaign because if just watching a few ads can put some money in your pocket or give you some cryptocurrencies that you can then turn around and trade, that sounds like the move.
Well, I think they're trying to put it into gift cards, right? Other forms of rewards, right?
Uh-huh.
Yeah, I think they're trying to create vouchers and stuff like that out of it. I don't know what the payout is. I haven't really studied it, but it does seem like a pretty interesting platform. I'd be interested in seeing what they do with smart TVs and how they integrate that into smart TVs and start pushing ads that way. I know my
That's a good question.
I know my Sharp TV actually has that option built into it. Um, but I've disabled it. I only use my TV for like for YouTube TV. So
Now, think about this. If there comes a time that this is integrated in the TV, I
mhm,
don't own a TV. I literally now I don't watch television.
mhm.
This could possibly get people to buy TVs just to have it running all day long. Not all day. What? Yeah, you might as well say all day long, just to get that those tokens.
Yeah, yeah. There's a myriad of ways of how you can go about it. It's just a matter of putting it into a common space because it wouldn't work for a person that's not watching the TV but has the TV running. Put it into a common place like a or a common space like a barber shop or a beauty salon or something like that to that effect. Then that makes a lot more sense. Um, because people can actually scan the QR code and pull that in from their phone if they see it, and it wouldn't be all that obstructive to the to, to the content that's being delivered. It would have to be strategically placed though. Let me get to this next one right now. This one's from Wired.com. A blockchain bandit is guessing private keys and scoring millions. Last summer, Adrian Benarek was mulling over ways to steal the cryptocurrency Ethereum. He's he's a security consultant. At the time, he was working for a client in the theft play cryptocurrency industry. Benarek had been drawn to Ethereum in particular because of its notorious complexity and the potential security vulnerabilities those moving parts might create. But he started instead with the simplest of questions. What if an Ethereum owner stored their digital money with a private key, the unguessable 78-digit string of numbers that protects the currency stashed at a certain address? That had a value of one. To Benerek's surprise, he found that dead simple key had in fact once held currency. According to the blockchain that records all of Ethereum's transactions. But the cash had already been taken out of the Ethereum wallet that used it, almost certain almost certainly by a thief who had thought to guess a private key of one long before Benerick had. After all, as with Bitcoin and other cryptocurrencies, if anyone knows an Ethereum private key, they can use it to derive the associated public address that the key unlocks. The private key then allows them to transfer the money at that address as though they were the rightful owner. The initial discovery piqued Benedict's curiosity, so he tried a few more consecutive keys, two, three, four, and then a couple dozen more, all of which had been similarly emptied. So he and his colleagues at the security consultant independent security evaluators wrote some code, fired up some cloud servers, and tried a few dozen billion more. In the process, and as detailed in the paper they published Tuesday, the researchers not only found that cryptocurrency users have, in the last few years, stored their crypto treasure with hundreds of easily guessable private keys, but also uncovered what they call a blockchain bandit. A single Ethereum account seems to have siphoned off a fortune of 45,000 Ether, worth at one point more than $50 million, using those same key guessing tricks. He was doing the same things we were doing, where he went above and beyond, Benedict says. Whoever this guy or these guys are, they are spending a lot of computing time sniffing for new wallets, watching every transaction and seeing if they have the key to them. To explain what how blockchain banditry works, it helps to understand that the odds of guessing a randomly generated Ethereum private key is 1 in 115. Uh, I'm not even going to try to pronounce that. That denominator is very roughly around the number of atoms in the universe. Benedict compares the task of identifying a random Ethereum key to choosing a grain of salt, a grain of sand on a beach, and later is asking a friend to find that same grain of among a billion gazillion beaches. I don't want to read this whole thing, but Mino, what's your take on this?
Okay. I okay. What happened was people that store their Ethereum and their private keys,
Hmm.
the algorithm that Ethereum used in order to give you your 78 alphanumeric private key, it started to become predictable. It wasn't as what's the one I'm looking for? It wasn't as unpredictable as other algorithms like SHA-256 or something, which is like the highest standard currently right now. It
Hmm.
it wasn't as unpredictable. It became predictable. So that quadri I can't even pronounce that right now either. That significantly reduced. And then when you store your cryptocurrencies, you're asked to put a secret code on it, like a password type of deal. And not too many people were doing that. So the guessing game got easier and easier and easier. Now, for those that are worried about their crypto being stolen, cryptocurrencies security will evolve as time goes on because this article is true. This is a highly hacked sphere. Thus, the custody solutions that these Fidelities and Backs and other exchanges are going to have because people don't want to keep their own money. They can be hacked. So cryptocurrencies security strength is going to evolve as hackers evolve. They're going to evolve together. But yeah, that's my understanding of it. The algorithm in which gave people that hold Ethereum 78 word alphanumeric private key, it wasn't as random as it was supposed to be. It started to become predictable. Not predictable as in, 1, 2, 3, 4, but for those who are knowledgeable enough and have the computer power enough, and gumption enough to go at it, they were able to crack a few.
So I'm still stuck when you were saying that people don't use the password. There are there are other security measures already in place, and you're saying that we're just lazy.
Yeah, yeah. Like I download I download a wallet, let's say a Bitcoin wallet, and it already has your private key. You have to hack that, but then you have to lock your wallet using a passphrase. That's just another security layer on top of that. But people don't do that because they're so used to being told that it's unhackable. Just that number, that something trillion, it takes a very long time to hack. But as computer functionality gets better and better, that time becomes reduced. So, but people are always used to saying, "Oh, this blockchain can be hacked. It's unhackable. It's trustless. It's this and it's that." So they tend not to put that passphrase on their wallet, especially if they have a fraction of Bitcoin, a fraction of Ethereum, or this and that. They tend not to. Why do people choose password 0000 for their phone? They're lazy.
Your brain can only store so much sophisticated information. It's just reality, and that's why passwords are going away. And you have multi-factor authentication because that's the only way to actually break that human habit.
And that's why I believe these custody solutions that Fidelity and these other big major players have will be successful because people are already used to storing their money in crypto, not crypto, in banks. And they're not used to being their own bank, which is one of the alluring aspects of crypto. Be your own bank, circumvent the bank, da 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 da. But when people invest in these cryptos and all of a sudden 5, 6, 7 years later, they become millionaires, your heart gonna beat a little fast. Like, oh wow, what if I get hacked? Let me go on over to Fidelity, Coinbase, and these are other people that have these custody solutions, so they can take the hit if they get hacked because they're insured, and I'll just get my money back in fiat. That's safer to them.
Mhm.
Well, there's no defense against stupid.
All right, this next one is from the WallStreetJournal.com. SoftBank founder Masayoshi Son lost $130 million on Bitcoin. Oh man, I took that article away. Masayoshi Son, the billionaire founder of SoftBank Group Corp, made a huge personal bet on Bitcoin just as prices for digital currency peaked, losing more than $130 million when he sold out, according to the people familiar with the matter. Mr. Sun, who launched the world's biggest venture capital fund on the strength of his long term investment acumen, made the investment in late 2017 at the recommendation of a well known Bitcoin booster, whose investment firm SoftBank bought that year. The people said. So you have a whale that lost $130 million on Bitcoin. What do you think about that, Darwell? Or I mean, sorry, I know.
It sounded like he bought in at the high because it said he bought in what, December 17.
Hmm.
So Bitcoin was like 19,900 at, I want to say, December 17th, 2017. So it sounded like he bought at the high and he didn't lose and like, oh, money fell in my pocket. He just lost the value in what he bought. went down, or the unrealized loss. So that's what I'm thinking the article is saying. Even though the title is sensationalized, he has an unrealized loss of 130 million, which means he bought he bought some Bitcoin. Because if you divide, let's say 130 million, right, divided by let's say 19, I think it was the high was like let's say 19,900, 19,900, which means he bought like 6,500 Bitcoin, which means now we know how much Bitcoin he has, which means you can go on Bitcoin's block, which is this is so dangerous because you're not supposed to tell people what you have, which means you can go on Bitcoin's blockchain and see who are what wallets holds a lot Bitcoin, and you can get an educated guess on this may be his wallet. This may be his wallet. Go ahead.
Educated guess or educated lame?
Both. Because trust only educated land gonna be doing this educated guess. So you you can and I know people don't like that phrase, but you can guess what wallets hold X amount of Bitcoin because only so many wallets hold like a large whale type amount of Bitcoin. So now people are going to be gunning for him because okay, well, I lost 130 million dollars. Oh, really? You bought the all-time high. The all-time high was about 19,900. Divide that to this. Okay, these wallets equal up. Let's try to hack you. That's how it goes.
Okay, how much money would this whale have to have? What would their net worth possibly be if they invested that much in Bitcoin?
Maybe he didn't buy it at the total all-time high. Maybe he bought it like 17,000, 15,000.
Okay, still, that's still only about a 20%.
Yeah, you still had some money to buy that much.
Yeah, I mean, if for you to spend that much in Bitcoin, this guy had to have. This would have to be one of the Waltons,
Yeah,
the Walmart, one of the Walmart people. Somebody with like more than 10 billion, and they say, "Well, let me just take this couch money."
right.
I mean, what do they need with the gain for anyway?
That's why it's so dangerous to tell people what you got because the crypto blockchain is public. You can go, they can go sniffing, and if they are determined, they can. Well, bitcoins. Uh, yeah. Just don't tell people what you got. That's all.
Mhm.
I don't know if I could tell people what I lost if I lost that much. But then you'd have to have about 10 billion.
Right. All right, let me get to this next one. This next one is from CryptoBriefing.com. Experts weigh in. Could Bitcoin hit $6,000 this month? Bitcoin has pushed far above the $5,200 mark, setting a new high for this year. The leading cryptocurrency continued to exceed expectations this week, and its a trajectory showed no sign of slowing as the American trading day gets underway. The BTC has gained more than $300 since this morning. At the time of writing, it had just reached $5,600. So this is just a chart. We'll go over the charts later. Technical indicators also turning bullish. Bitcoin's 50-day moving average has moved above the 200-day average, a pattern known as golden cross. The pattern indicates that short-term momentum is exceeding long-term trends, suggesting that prices might continue to rise for the foreseeable future. With this in mind, we asked industry figures if Bitcoin could hit $6,000 mark, recouping the losses from November's crypto crash by the end of April. Um, what do you think about this, Lionel? And then I'll go to Dollar Will. Um, if he's going to pull up some charts tonight.
My only thought with this is I hear this so often how people say in a crypto, these crypto videos and these crypto articles, they happen so common. Bitcoin is going to do this. Bitcoin is going to do that. This, that. 6,000 by 12 o'clock p.m. Eastern time. And that's what I hear and that's what I see. It happens so often. So I start to lean more toward technical people, like Dollar Will. You have Tone Vase. You have other people in the crypto sphere that goes over the technical because I'm bombarded so much about articles and videos on my timeline with people saying, "Oh, now that Bitcoin jumped up to 52 to 5,500, that little range." Then they come up with this. Well, the next what do they say? The next psychological um, jump is 56, and if we go to 56, we're going to 6,000. That happens so often; it's ridiculous.
Yeah, but does it stay that way at the closing bell? Is really the question.
Their predictions never really happen. Tell you the truth. That's why I lean so more toward the techniques because it seems like they're more logical and based in reality.
Hmm.
And the people that really say this stuff, they just want it to go that way. They feel that, oh, since it went up, then it has to go this, and the next psychological threshold is 57.25, and if we hit that, it's more feeling and it's more emotion in it, and you're drained after you hear and see all that a lot.
Right. I'll say I'm gonna of course talk about the chart later in the open section, but it's a struggle from the technical side. Generally, we don't care because we know we can make money whether it's going up or down. If you want to short it, you can. So that helps to take us out of the cheerleading role. Now we're humans, and we have egos, and sometimes we can get too into our own call on the charts. But I do think that the technical traders are more objective because we don't care. There's always something to trade, or you can short. So,
Hmm.
but I'll show in the charts later why I do not believe that it's going to happen. It's getting pretty clear on the chart after the move today.
All right, this next one is from CryptoBriefing.com. Smartlands wants to build a real estate market on Stellar. You'd be hard pressed to find an asset more uh, illiquid than illiquid than real estate. Property can take months to exchange hands. It's a lengthy, complicated process, and the fees can be astronomical. But one project is using Stellar to provide much needed liquidity to real estate and make it easier for investors to gain exposure to the UK property market. Smartlands SOT, which is headquartered in the UK but also has offices in Vilnius and Kiev, was the first ICO to take place on the Stellar blockchain back in 2017. It allows developers to issue tokens that are linked to a specific property. Investors can buy and trade these tokens on the Smartlands platform, as well as sell them in secondary market. The first property to be tokenized is a student accommodation block in the city of Nottingham. Around 30% of the building's equity will be available to purchase in the sale, hard capped at 1 million euros, roughly $1.3 million. The city of Nottingham. That's where my family's from. Just as FYI. These tokens allow investors to hold a small fraction of the building's equity, explains Smartland CEO. What the hell is this? Sorry about that. Kind of lost my place. All right, these tokens allow investors to hold a small fraction of the building's equity, explains Sparkland CEO Arnold Naseda. Investors can expect monetary returns from the tenant's rent as well as from the eventual sale of the property. For the Nottingham accommodation block, investors can expect annualized returns of more than 16%, according to the company's website. How to invest in tokenized real estate. The investment process is very simple. After passing the requisite KYC AML checks, investors can browse projects featured on the platform along with details of the on the properties, financial information, and the proposed investor agreement. Once an investor has selected a property, they participate in a token sale, which bears some similarities to an IEO. They can choose either to invest with fiat currencies like the pound sterling or the U.S. dollar, or with cryptocurrencies such as Bitcoin, Ether, or Lumens tokens. Investors receive their security tokens once the sale has concluded. They can be held on the platform, stored in a custodial solution, or traded on a secondary market. Although linked to a specific property, these digital assets technically represent equity in a holding company, which becomes the legal owner of the property in question. Nasuda or Naseda explains that these can. This is grammatically wrong. These companies can represent just one property or for a collection of buildings, allowing investors to gain different types of exposure depending on what they are looking for. So, what this allows is to circumvent REITs, right, Dollar?
I am struggling to understand this myself, honestly. This is
Well, I know. Do you want to explain this?
not making sense to me.
Um, okay. Remember when we say it's a lot of the things that we talk about, or a lot of business is not a zero sum game. I don't think this is a zero sum game in terms of it can only be one, which are REITs in the traditional marketplace. We always talk about how, well, I always hear that the cryptocurrency space is a nascent or new asset class, and this is just another way to invest into assets. With the REITs, a lot of REITs have they invest in malls, invest in a lot of commercial spaces, and apartment buildings. With the crypto, now you have people that can. There's let's say there's a $68 million building in Manhattan, and a company take their building, fractionalizes it, and have X amount of tokens. It's like 120 million tokens. Now, instead of investing into one REIT where you can get a dividend every few months or every month, depending on how often they pay out, you can actually own part of their building, get dividends or per rental, and once the price goes up and down per their token, you can sell it off. So this, to me, looking at this, is just another way to invest in the real estate that a is on par with REITs, but has another level in terms of you can sell it when a price goes up and trade it.
Mm.
That's the way I'm looking at it.
I was as well. It doesn't. Well, not that it doesn't really go into detail. It does go into detail, but I was thinking that this is like they basically have not so much as hijacked the REITs, but to actually advance it from where REITs typically was. I mean, obviously we understand the structure of REITs on this hangout, but when you think about adding blockchain, adding cryptocurrencies, adding tokens, and adding smart contracts, and all as a part of the pieces of infrastructure, that's an entirely different perspective that hasn't been sought out before.
Agreed. Agreed.
What's the advantage of participating in real estate this way versus a REIT?
Now, there may be buildings, let's say on Australia's Gold Coast, there may be buildings there that you can invest in, particularly, not particularly, I say particularly, specifically, than just investing in an umbrella REIT. We hold these properties, not specific properties, but we hold these are the type of properties we invest in for as opposed to a crypto.
So
Let's
you're
say
saying you could build your own real estate portfolio of the
you can build your own
individual.
real estate portfolio specific to buildings. Let's say a crypto REIT, just to be, for sake of argument. Opposed, well, when a crypto REIT, you can build your own portfolio specifically. Hey, I got pieces of um, state Empire State Building. I got pieces of the Burj Khalifa. I got pieces of such and such building.
As opposed to a REIT, you have to take whatever's already in it.
Exactly.
Gotcha. Okay.
See, like brain trust.
Yeah, I can see that being good and bad. you know, it's like if you're knowledgeable, you can make that a knowledgeable person can make good decisions, but someone that doesn't know what they're doing but think they do, they
Mhm.
might be better off with a REIT.
But then that's good though,
But
because
then
like I
you
said,
But
go ahead.
freedom is good.
no, go ahead, Lionel.
Yeah, that's good because if a person feel they can't compete on that level, then drop back down to the traditional REITs, and
Right.
those are safe.
But
That's
what's going
cool.
to what the point that I was going to make is that when you include artificial intelligence into a platform like this, you won't need to go back to the old traditional ways because the AI or the deep learning aspect is going to point out um, the trajectory of where it's going to go based on the technicals that's already been fed to it in the data sets. So in layman's terms, the artificial intelligence is going to make a decision for you ahead of time based on the um, the history that's already been presented to it. So if it's a good deal, it's going to tell you that it's a good deal based on the technicals. You won't have to have any sort of
Knowledge. Okay.
well, you won't need any expertise from a certified financial planner or
Mm.
CPA. You won't need that.
And that's and that can be like another level into investing in the crypto REITs.
Hmm.
And now you just took it to another level.
Yeah, that's gonna be something. That's gonna be. I don't know if I'm gonna like that. That's gonna be disastrous if if knowledge is democratized. We need the idiots.
Well, it's already democratized now on YouTube, and look where YouTube at now.
Well, there's information available, but people don't use it. you
Oh, you
know,
mean they don't subscribe to Dollar Will?
there's that, and people don't read books, and it's all kinds of, but yeah, but if with artificial intelligence comes along, does all the thinking for people, that's gonna dry up the pool of dumb money. And in the investing world needs it's fueled off of dumb money. Someone having more knowledge about the value of real estate or stock or some, you need It's in stocks. It's called the greater fool theory. You need that idiot on the other side of the trade.
I
Mm-hmm.
disagree with you, Dollar Will. I think it's going to be more.
Okay.
I think it's going to be more because
How?
more and more people are, more and more younger people are investing into crypto opposed to them. If crypto wasn't there, them investing into traditional stocks. So you got more and more people investing in the crypto. It's a new thing. It's a hip thing, and you got more people making videos on crypto opposed to traditional stocks. Now you have these content creators slash influencers making these videos saying, "Oh, you can invest in this. That means more and more people, as more people transition to social media like YouTube and look at and get their information from there, you're gonna
Not
have
even
more
just
people looking at this.
Yeah,
yeah,
but
not
Mike,
even
but
just
Mike
not e-
mentioned.
yeah,
I'm
but
sorry.
not even just no. I was just gonna say that not even just that. You'll have new traditional in or at least what's considered to be traditional in the crypto sphere exchanges and new exchanges coming online that will do a lot of that work for you.
That's what I'm saying. That's the scary part. If artificial intelligence is doing the thinking and protecting the idiot. So I'm not now. I'm not trading against someone's stupidity. I'm trading against the swiftness of their artificial intelligence.
Hmm. And I don't know if a human can actually compete against something like that because a human only has intuition, whereas the AI has large data sets that it can sniff through based on the amount of horsepower that it has from a CPU.
I guess the only I guess the counter to my argument is there's a lot of artificial intelligence driving, say, stock market right now,
Oh yeah.
and so you can still my point of view is that's where these flash crashes are coming from,
Hmm.
because certain technical things go off and make all these computers respond to the same signal.
Hmm.
So maybe there's hope still. Yeah.
Who says you can't teach an old dog new tricks? All right, this next one is from CoinDesk.com. French leader Societe Generale issues $112 million bond on Ethereum. I would not want to put anything on Ethereum at this point. French financial services giant Societe Generale Group has issued about $112 million worth of bonds in the form of a security token on the public Ethereum blockchain. Announced today, a subsidiary called Society Generale SFH used the OFH token to represent 100 million euros of covered bonds, a type of security that is backed by specific assets but remains on the issuer's balance sheet. However, according to a report published Tuesday by bond rating agency Moody's, Investor Service Society, Societe Generale was the sole investor, meaning the firm issued the securities to itself and no outside buyers were involved. The bond has a 5-year maturity with 12 month extension period, Moody said. It is pari passu on equal footing with other covered bonds of issuer. Meaning if the company were to fail, whoever held the tokens at the time would be repaid the same fractional amounts at the same time as regular bondholders, the report said. The rating agency said it considers the use of blockchain technology credit positive for the issuer and in part because of increased transparency and reduced likelihood of errors arising from the complexity and the number of intermediaries involved in issued covered bonds using traditional means. I know you sent this in, so what do you think?
Well, well, to me, this really speaks about a adoption. You have major companies. These are like if these are like whales adopting and going into crypto. And you have governments putting things on the Ethereum blockchain, even though Ethereum has that what's going on. It's just going to get stronger.
Hmm.
And now they're putting bonds, things that is relegated to traditional markets, bonds on an Ethereum blockchain. That opens up. Okay, I want to paint a picture for people. Crypto is an up and coming investment asset. It only been around for 10 years. 10 years. We're still fiddling around with what doors we can open that will open new worlds to investment in the cryptocurrency space. Bonds is another door that we just found that can open the door to more liquidity, more investment, more access, and more I forgot the word I'm looking for. More I'll just say achievements. Now, my question is to Dollar Will, what do you think about these people putting bonds on a crypto, like a blue chip crypto as a Ethereum?
Um, Capitalism, man.
Thank you. It's just capitalism,
Okay,
just making
it
money.
doesn't
It's
even
new.
have.
Make
Yeah,
money.
it doesn't even have to look. I don't. It doesn't even have to be a good idea. Well, greed rules.
Mhm.
Okay, people would like to make money. They've developed the structure where you can buy a bond, and so I guess the bond is what it's going to back the crypto.
No, no, no. It's not still going to back to crypto. God, I read this earlier, and but it's not going to back to crypto. It's not. Um,
So what's going to back up the bond? The bond's a debtor instrument.
Yeah, right.
So
Well, yeah. What do they use
so
the
so
money for? That's what I'm saying.
at the end of the day, is it going to be the people who are going to be the creditors to this bond that's going to back it up? You see, what I'm very disturbed about, being on Wall Street and seeing all that's going on, knowing Moody's was a big part of one of the rating agencies that were rating a lot of these investment grade uh, instruments as AAA rated and that kind of stuff like that, when they were actually freaking dogs with a lot of unsecured assets that were in there that really created the crash in the market in 2008. And they were players in this who gave false ratings to a lot of other to these securities that were garbage. Now they're coming in doing this in the crypto game, which really supposed to be more of kind of a libertarian type of thing to kind of keep itself out of the clutches of these savages. And now you're putting blockchain with the fucking sharks, pardon my expression, um, makes me highly suspicious. Societe Generale, SocGen, who was going to be backing us up and now saying, well, if we don't go, who's going to freaking cover it? Yeah, I don't know if the EU is going to cover this kind of situation because they're a European company, or if something goes wrong, they're going to have to be bailed out like us. Like we did before, 2008. I have a lot of serious questions about what's going on here.
I mean, you're
Um,
not
and,
surprised, though, are you?
and I'm personally, I don't like it. No, I knew this was coming, and this is
All right.
something that I see that they're going full well ahead with it. And I between you and me, I can't give this a passing grade. Knowing what I know,
Right. That's what I'm saying. I wouldn't. I
I'll
would.
leave it at that.
Yeah. This is just good old greed, good old fashioned greed.
Good
You
old
know.
fashioned greed. That's setting it up right now and setting the blockchain up to get wiped out, just like they did with the overall stock market, and the other and any other basic trading markets that are out here. That see, to me, I believe blockchain should be independent of this. This should be a way around that effery, but
Now see with
it's
blockchain,
not.
it's on just only thing the blockchain is going to be doing is taking account of it's just an updated ledger.
It's going to put on a general ledger system. Say this is what we have. It's going to
Right.
leave it to the same level of frauds and so forth.
Well,
that
since it's on Ethereum
ideally.
blockchain, I don't think it's
Mhm.
going to be that level of fraud.
Oh, I don't.
You
I do not think you can peer into that at this level and make that statement.
I don't think
I
blockchain is
just
the
don't.
issue. I think
No.
let me see. Nagone, is blockchain your concern, or is it just the general
yeah,
traditional effery of capitalistic forces
right.
that's going to,
The
you know,
Moody's rating systems and so forth, the blockchain
yeah,
will be there, but there will be ways to corrupt that system in
correct.
which to
No, well,
in which to I believe to commit some of the frauds that we saw back in 2008. But that's that's my take on the subject. You guys can agree or disagree, which is fair enough. But
No,
that's just my input
no,
well,
I got a
I,
question. I got a question for you
as
to
of
go.
now.
I got a question for
Mhm.
you to go. Now we know that this same level of effery happens in traditional publicly traded stocks. Do you think that?
And you know and now we're in the bond market.
Yeah, right,
This is
right.
scary.
And then let me add this. My question is: do you think what's going on now is like a new low, or just par for the course? I think it's just par for the course.
I'd say par for the course and a tad bit of new low as well.
I'll say this: the blockchain, whatever you put on the blockchain, is only as good as what you put on it. If they're putting corrupt messery onto the blockchain, then
Mm.
that doesn't mean that that blockchain is messed up. The bonds in which they're putting on there for people to trade and sell and buy and all of that, those are messed up. That don't mean that
Yeah,
Ethereum's blockchain we messed up.
I'm not going to say that Ethereum is corrupt. I'm not saying anything about Ethereum or any other of the other blockchains that are out here. I'm saying how it's being utilized. How is it being used as an instrument? That's that's what I'm concerned about. How it's being used.
I think we're going to end up with the same confusing array of instruments to invest in, which is like derivatives of derivatives of derivatives. You know,
I don't like Wall Street and these players. SocGen is a player, as well as others. I don't like them coming in on this. I don't like what's going on here in the
I think
market.
I see when I think I see when the going is going with this. I know if I can try to elaborate.
Oh, go ahead, go ahead.
I think what he's saying is that they will cook up their own blockchain, and despite the fact that it's a blockchain, that they will manipulate it to their own leverage it to their own advantage,
That's
and
exactly correct.
that there has been a lot of questions in the past about an article we went over I think earlier this week about healthcare and all these
Put
promises
that in a
about what
blockchain.
blockchain can do for healthcare, and a
Yeah.
lot of the doctors and the institutions are saying we are not convinced, right? So there is a there with what Akon is saying.
Right, and that's why I was saying the blockchain is only good for what you put on it. If you put bad information on it, only thing you can do is amend it by putting the good information on it. You can't go back and change it. So if they're gonna do their own blockchain and put bad stuff on it, then only thing they're doing is just bringing the trash from the traditional over to the crypto and saying, hey, this is block and just using blockchain as a way to get investment. That's it.
but but it offers transparency for auditing, right? So
True.
your anti-money laundering launderer and auditors are going to look at that and say, well, that's that data is sufficient, but because they're not looking at the integrity of it, they're just looking at the availability of it.
That's right.
The fact that the data is available is good enough for them, and we saw that with what's the institution that did the audit for Equifax. I forget the
Are you talking about not PricewaterhouseCoopers?
the other one,
Lord.
KPMG.
Ernst
I think it was KPMG.
KPMG.
Okay.
Yeah, I think they did the
Yeah,
audit, and it turned out that that audit was
yeah,
actually flawed. So
yeah,
there is a there to what Nagone is saying. But I want to
yeah,
get to
yeah,
the second article.
yeah.
Hey, Mike, real quick, can you refresh that because that Bitcoin price is? I want to see if that's the right price.
Hold
Took a
on.
little hit today. If that's right. Yeah, that's right. Okay.
Oh yeah, that's gonna be the star of the chart section coming up.
All right,
Hmm.
let me get to this next one. CFTC Chair Gian- Giancarlo hints at what's holding back Box Bitcoin futures. This one is from CoinDesk.com. When Bach. The question has been posed repeatedly since last summer, when Intercontinental Exchange I, ICE, the parent company of the New York Stock Exchange, first revealed its grand vision for a Bitcoin futures platform that would help take the cryptocurrency to the next level of mass acceptance. Bach has postponed its launch date twice now, including an indefinite delay at the end of 2018. It's widely known that Bach's holdup is regulatory in nature rather than technical, but the specific reasons for the delay have been hazy. The subject of rumor and speculation in crypto legal circles and anonymously sourced news articles. This much is clear. Bach needs Commodity Futures Trading Commission (CFTC) to provide a final green light before it can launch. In blog posts, Bach CEO Kelly Loeffler has said the exchange is working with the regulator, but offered little in the way of detail. Bach declined to comment on this article. The CFTC, for its part, has kept quiet about Bach, so it's hard to tell where in the process the agency is. However, CoinDesk recently sat down with CFTC Chairman J. Christopher uh, Giancarlo, who became a hero to the crypto community after advocating for a do no harm approach to regulating the space before Congress in early 2018. So, Lionel, what what's so significant about this that you want to tell everybody in the chat?
Okay, so back has been supposed to have launched already like 3 times. It's like I think this is the third time it's been pushed back. And back this, excuse me, it comes from the people who own the New York Stock Exchange, ICE, Intercontinental Stock Exchange. They have gone into partnership with a few other companies such as Microsoft, Starbucks, and a few other companies to launch an exchange. It's supposed to be a custody exchange also, so people can invest in the cryptocurrencies and even use the cryptocurrencies, excuse me, to purchase other things, such as the infamous, you can use Bitcoin to purchase coffee. But people are questioning, well, why is this thing keep getting pushed back? You all are institutions that's been around for decades, and even you all are not being able to get the go ahead to go to launch you all's platform. So now people are saying, well, this don't make sense. It got to be something to this. So now people are saying, well, government, these high institutional well players, they want to get into, they want to control crypto. Crypto is no longer something where everyday person can become equal in wealth with the whales. It's been co-opted, was what we can see. So now these people are trying to get in this new asset class. This is the theory that is slated to be worth 20, 50, 30, $100,000 and plus more in the future. So they want to make sure they have control of this, then give the go ahead to these institutions, the ETFs and so forth, in order to sell to the public. That's the theory, because this thing has been back for the third time already, and it may be pushed back even further. And people are trying to figure out what's going on, and as little by little by little, trickles of information has been coming out that people are trying to put a bigger picture together as to why this thing has been pushed back.
Yeah, I wouldn't worry about it. You
Oh
can
no,
bet
I ain't
on
worried about it either.
you can bet on greed. They'll figure it out. There's too much money to be made there. you know,
And
especially with the volatility of cryptocurrencies or Bitcoin. That's moving up and down. There's just too much money to make
right,
on those
it's too much
wild.
money.
Yeah, they're
It's too
going to
much
work out.
money. And yeah, oh yeah, they're going to work it out, and they're going to work it out at the most convenient time, quote unquote convenient time. So when it's worked out, they're going to be in a position to make as much money as they can.
All right, this next one is from CNBC.com. U.S. economy grows by 3.2% in the first quarter, topping expectations. The U.S. economy grew at a faster pace than expected in the first quarter and posted its best growth to start a year in 4 years. First quarter gross domestic product expanded by 3.2%. The Bureau of Economic Analysis said Friday in its initial read of the economy for that period. Economists polled by Dow Jones expected growth of 2.5%. It was the first time since 2015 the first quarter GDP topped 3%. The upside beat was helped by net trade. Exports jumped while imports contracted sharply, and in inventories, which combined contributed almost 170 BPS of the rise. Personal spending, though, the biggest component was up just 1.2%, 2/10 more than expected, as an increase in spending on services and non-durable goods offset a decline in the spending of durable goods. Exports rose 3.7% in the first quarter, while imports decreased by 3.7%. Economic growth also got a lift from strong investments in intellectual property products. Those investments expanded by 8.6%. Hopefully, the Black Brain Trust was one of those products. Disposable personal income increased by 3%, while prices increased by 1.3% when excluding food and energy. Overall prices climbed by 0.8% in the first quarter. Friday's data was the first look at how the economy fared during the longest government shutdown in history. The federal government ceased operations for 35 days late December and January 25th amid a standoff between the Trump administration and congressional Democrats over funding for a wall along the U.S. Mexico border. Investors were closely watching for the report as they look for more confirmation that a recession may not be in the cards over the short term. The report helps offset fears of slowing global growth, said Alec Young, managing director of global market research at FTSE Russell. At a time of lingering U.S. Chinese trade uncertainty and weak economic data everywhere, from Germany to Korea to Japan, strong U.S. data acts as an insurance policy against further global economic weakness. And with inflation still subdued, it's too early to start worrying about Fed rate hikes again. Well, this is just a chart, but okay. So we did well the first quarter. Doesn't tell you what's going to happen. You know, come quarters 3 and 4, anything can happen then. So
Yeah, that data is backwards. It's always about the past. So I guess if you are a fundamental trader, that's great information. So it means nothing to me. Absolutely nothing to me. So there's some people that trade on both, and for the people that do, you have to ask them, how you do that? how do you juggle one versus another? Which do you weigh more? You have to ask them how they do that. I'm a technical purist. I don't have that issue.
all right, this next one is from 2 cents. If you want to retire early, invest in rental properties.
Oh, I can tell you that right now. That's for a fact. But
Well, let me read this article first, and then we can get to it.
okay, but there's one thing I want to say about the economy before.
Okay.
I would say just one a caveat. Just look at interest rates. That's all. Just as long as interest rates stay where they are. The president has been fighting to keep interest rates low, so that'll keep the economy moving. But as soon as we start to see the interest rates begin to incrementally climb up, we'll start to see things slow down. All right, that's it.
hmm If you're pursuing financial independence and early retirement, you've probably heard about the 4% rule. When you're calculating whether your investment portfolio will cover your cost of living, assume a 4% withdrawal rate. The 4% rule is based on two financial averages. First, the 4% rule says that your stock portfolio will grow at an average rate of 7% annually. Second, because the average rate of inflation is 3%, you can safely withdraw 4% of that growth, leaving 3% behind to keep up with inflation. Because you're only spending the average incremental growth from your portfolio, in theory, you should never run out of money. However, Paula Pant at Afford Anything has done the math, and if you invest in rental properties, you'll be able to withdraw 6% instead of 4. This means you'll get a bigger monthly payout after retirement, and you might even be able to retire earlier than expected. Here's how she explains it. If you're if you're retiring on index funds, you might plan your retirement on the 4% withdrawal rule. But if you're retiring on rental properties, you could use the equivalent to a 6% withdrawal rule. This holds true if total returns on the two investments are the same. Why? Two reasons. One, the returns on the rental property bias towards an income stream rather than capital appreciation. And two, rental properties don't hold the same risk of withdrawal than withdrawing the principal. Her full post covers why rental properties bring in more cash flow than index funds, why rentals are lower risk investments than equities, and how you can get started with rental properties even if you don't have a lot of money to invest. If you started investing in rental properties as a way to create passive income and or retire early, let us know if you think the 6% rule is accurate. Nagon, you were going to say something about this. Jump right in. Go ahead.
No, I wasn't gonna, gonna say much. I just was gonna say that rental properties or certainly, investing in rental properties and buying property, even flipping. Well, flipping it, you get quite a bit of depending on where you invest, develop the property, and then sell. You can have a tremendous amount of income that can hit you quickly in a fairly short period of time, 6 months to a year, depending on the area that you're in. But long term, as far as income is concerned, rental properties, without a question, 4% rate is good, but you're going to get a lot higher, depending on what area you're in. You can really do very well with that, and that's exactly what I'm trying to do. Pick up 10 properties over the next 2 to 3 years. I should actually have income coming in, yearly income coming in close to $1 million, depending on how I'm averaging my costs, and that's kind of what me and my brother are looking at, how we would look to average this out. But we could do that and live off of that for a long period of time, um, while just running your property. So yeah, so that number I think there is fairly um, fairly accurate, and I think that's exactly what people should do, as opposed to when I say opposed, you should have a few different investment vehicles, but certainly as far as rental properties are concerned in real estate, I think it's definitely a much safer investment. And it's even somewhat recession proof in the sense that you might not be able to sell the property very quickly under a recession. But as far as recession is concerned, people wanting to rent and continue to instead of buying, that will increase. So that will keep your income actually flowing in fairly well, even under conditions of a recession. So that's my uh, that's my take on that. That's what I want to say.
Yeah, I'm not currently investing in real estate, but I'm attracted to REITs. Not right now, because
Hmm.
I think that real estate sector is going to take a beating. But I like the REIT approach. I don't want to deal with tenants. I don't want to
Mm,
fix no roof,
mm,
buy no air conditioning.
mm,
I just
mm,
give me the dividend.
mm. Okay. Rental property. I mean, when you're doing that, it's more of an income play. REITs. That really is a tremendous. That's an appreciation. You have a REIT, sell a REIT, boom, can make some nice money on that as well. But that is very, very, very subject to market forces, especially interest rates, and that could affect it because a REIT, unlike a house, is securitized. It's a security, as opposed to where a house is a property. That's not securitized by any type of trading exchange or whatever. But REITs are good. I mean, REITs are good, but interest rates start to go up, you're gonna have some issues with that. That's all. I mean, but I would not disagree with you on that, especially if you don't want to deal with repairs and keep a property and that kind of thing. Yeah.
I know you have anything you want to add to that?
I actually agree with both of them. I'm a dividend person myself. I like dividends. I have not invested into physical property, but I am not opposed to it. I like both aspects. I'm not going to say it's either this or that one, and I'm not going to argue with anybody how REITs are better than physical property and physical income property is better than REITs. They both give you income, so how is one worse than the other? Only how one worse than the other is one you put more work in, physical work in, the other one you don't. But they still bring in money. I agree with Agone when he said that physical property is more recession proof opposed to REITs. REITs can go down in their stock value, but you still receive your dividend. And physical rental income, yeah, the price of the house may go down, tantamount to the price of the REIT. Stock may go down, but people still have to have a place to live. So, I'm not going to sit here and say bash REITs or bash physical income property. Both are good. You're still receiving the income. Just like 2 weeks ago, we went over one article how the guy was saying REITs are better than physical rental income. Now you got this article saying how physical rental income can provide you a income in retirement. Both are good in my opinion.
Yep.
Why not have both?
I mean, I would totally agree. It's very interesting. I'm dealing with a friend of mine who we've been friends with since high school, and he worked for TIA Craft for quite a few years in their real estate acquisitions area. Hired a lot of people from me as well. Now he has opened up his own. He and three other partners have opened up their own real estate investment firm, and we're looking at a REIT right now in Harlem, and looking to buy some brownstones, pick it up, and hopefully I can get that. If I can flip this property, get some money from that, invest in that situation, that could potentially work. So I'm trying to actually get more into the REIT game. He actually wants me to get involved with him more in the aspect of selling as well. But I would have to renew my license as far as trading of which would be fairly easy for me to do. But this is something that I'm actually currently thinking about doing actually with him because I was his stockbroker for quite a few years. He made a lot of money with me, and then he actually has. Then when I moved into the placement industry, he hired a lot of people from me, and now now we're looking to to get into some pretty high level investment with his firm. So it's always good to have good friends who are in business with a lot of money and a lot of and a lot of and a lot of investment opportunities, because that tends to help out quite well over the long term. But anyway, yeah, this is a situation that I think could be real good for people if they do want to take a look at REITs. I totally agree with everything that Lionel just said, as far as being involved in both, because both do have great upsides, and both do have their downsides as well.
Mhm.
But get involved. I think real estate is something that I think for the long term is always a good investment. That I'm seeing that this time, more time goes by, they're great. So REITs or physical properties themselves, I think work quite well, especially if you're looking more towards retirement, of which I think people in their 40s who sort of hit their 40s should be really starting to look at and plan out. Anyway.
Mhm.
Well, I just want to reinforce that I'm not a certified financial planner. Just a guy on YouTube. My, it's just my opinion. Get your own certified financial planner from what's that site? Mike Lionel, what's that site?
CFP.net.
CFP.net. Okay. And then I would say when you find one, ask them, do they know technical analysis, or do they subscribe to a service to provide that information? If they don't if they don't use technical analysis or subscribe to that information, run. Go get another one.
Yeah, yeah,
Okay.
yeah.
Okay. Because the certified financial planner is going to give you excellent fundamental analysis, but you want one that
Yeah.
also knows technical analysis, or at least subscribes to a service giving them that opinion. Now, as far as
Yeah.
dividends go, right at this moment, I'm interested in the utilities because in this downturn, utilities should be fine, and those are pretty good dividend payers.
Well, yeah, yeah.
You know.
But that's the whole play on the dividend on utilities. Utilities are more of a dividend play.
Right,
You're
but
not
but
really
in a
looking. Yeah,
downturn like this, you're going to get
yeah,
stock price appreciation as well.
yeah, yeah. You certainly can, but I think but utilities tend not to rise that high. You're not getting that huge of swings in appreciation, but you can get appreciation
Well,
during those periods of time. You're right.
generally you're right, but this in this downturn that we're going, I believe that what we're going to see if we when we have this downturn is the way that utilities led and that decline in 2018 from October, no, November, first week of November
Mhm.
through Christmas. The sector that made, or the industry that made the most money was utilities, and that was in stock price appreciation. So that
Hmm.
is the exception where utilities see tremendous stock price appreciation, because a lot of big money is going to hide out there, and that volume is going to cause that price to go up. So generally, what you're saying is true, but in this, if we have not if, when we have this correction, that's going to be a hot spot. But so that's the only thing. So that's what I would like to. I'll be turning my attention to the utilities and avoiding real estate like the plague, until the correction is over, and then I'll be interested in real estate from an investment. That's just my
When you talking about real estate, are you talking about physical investment with properties, or are you talking about more from a REIT perspective?
both. I wouldn't
I
want to.
don't
I
know.
would. I wouldn't. Let me. I would not be interested in acquiring any real estate unless I was getting it at a very deep discount. Some type of
Well,
a bank owned property, or some kind of seriously distressed sale. 'Cause where you're buying it so far undervalued, under the market, that it probably wouldn't even matter. And there are deals out there where people are getting deeply discounted real estate that even a correction is probably not going to matter at the price that they got the real estate. So
Okay, so what I would say is, you always want to buy real estate at a relatively low price and look to sell high. That's fundamental basics. I would say in investing in real estate, you always want to you don't want to certainly buy it at the highest price, and you certainly don't want to buy real estate if you're going to go into a bank or anything else like that and get a loan with a fairly high coupon or interest rate on it. So you want to come in there at a low price. I believe certainly where I disagree with you on is I disagree with you on the fact that physical real estate, I believe, is always a good investment
oh,
because
whoa, damn! I'm
it's
sorry.
that
I'm sorry. You just
it's
you gonna kill me on here, man. Oh my God! I can't. That's the beauty of this. The gone. You
it's
just
steady
put
income.
it out there, and the universe will show who's right. It's gonna always show in the chart. It is not, but this is beautiful. Excellent. Go ahead. I'm sorry, man.
Well, I'm just saying, I believe that physical real estate can it's always a good income play for long for investors who are playing more in
Oh,
the long
agreed.
term.
Agreed.
Physical, and
Income
REITs
play.
and all that. Yeah, so it all depends on people's opinions. I was in this business, and of course I'm in real estate now. I put a couple of vids up, and I'll put some more stuff up as far as some of the highly borderline shit we doing right now. It's some stuff's getting to be off the chain, but definitely that's kind of where my head is, and some of the other people who I see who are starting to make some pretty serious bread right now are at this stage. But like I said, for those who are certainly interested in owning property and so forth, research it, go into it, look at it deeply, and look at the areas that you're in. Do a lot of research where you're buying, because that will certainly
So when you say buy
determine.
low, I just want to get clear on what you're saying. Because
Hmm.
when I say buy low, I'm talking about distress sales. Okay, REITs,
Okay, you could
foreclosure.
say distress sales,
Okay, but I just want.
foreclosures,
Yeah, is
these
that
type
what
of
you're
things.
talking about? Are you?
Certainly, so certainly, of course, that would be a part of it. Absolutely,
Yeah,
absolutely,
because
of
that's the
course.
only. Because when you say yeah,
Yeah,
buy
and
low.
I'm not saying that's the only, because there are the houses that you have to understand. If you're going to go into a house, and if you can do a lot of work, right? You can do a lot of work, and you can repair a house. You may get a house that may be in a great area, but the house is not really upkept well, and so forth. But yet you can come in, do a lot of the work. You could have a house that could say, let's say, it should be worth $450,000. All right, but the house is depressed. You want to jump in here real quick?
No, I just
Somebody
wanted
was
to let Dollar
somebody.
know. I just wanted to let Dollar know he has the floor. He can post his charts if he
Uh-huh.
needs to.
Okay,
Okay.
I would go ahead and go.
Yeah. So I was just saying, you want to, if certainly if the property is in bad shape and it's not going to fetch the value that it's going to have, then you can do a whole deal in that, whole reformation there yourself. And if you're good with it, handy, you got a good team, you can come in and put some good, uh, um, materials, appliances, and so forth in there. Really build that property up nicely at a cut rate cost. You'll see a tremendous amount of profit. But that's where the work comes in on the kind of sweat equity. That's kind of what we did with this house. So that could work out very well for you as well. So there are a lot of mitigating circumstances. Just you have to kind of look around and be smart about this as well. So anyway, that's all I'll say about that for now. But go ahead,
Yeah,
post your charts.
it's good stuff. That's a worthwhile debate on that real estate and that timing, because being upside down in a mortgage is no fun. So as you know, I guess my opinion is biased because I think that we're at the top of the market. So it's
Mm-hmm.
now there are people who don't believe that, and so for
Mm-hmm.
them, they think that it's always a good time until you know they get caught upside down in the mortgage.
Well,
You know,
well, the key of right now, if you can put cash together in which to buy, um, that's the best way to do it. Having to get a loan on a property and move out. That's so that the house that we got was, we were able to put cash together and buy cash out. So
right?
so there's no note on it.
Yeah,
So that's why the profit margin on that will be so large. So that's the advantage.
and I will say, if
Okay.
there's anybody out there listening and you're in the mortgage industry, drop a line in the in the chat. I think that we need to talk to somebody about who's in the mortgages, and maybe come on and talk about reverse mortgages. It's something that I think our people need to know about. Know that it is something to consider. you know if you are, have parents or someone in their mid to late 60s, that's a way for you to get, I think, up to like 65%, somewhere in that area, of the value of the house in cash. And there's some issues with it, but it's something that people at least need to know how to do. Because I know for some people, um, I know my father did it, and I know some other people in certain situations where they don't really have. Some people maybe not. They don't have anybody to leave the property to, so they're not concerned about somebody inheriting the property, and for them they may rather have the cash if they're senior, and having that money in the bank might offer them more peace of mind than just sitting there with the equity in the house and struggling. So it would be something to it would be a good conversation for somebody who's a professional in that field to come in and talk about. So if it's anybody in the chat or anybody out there listening that knows about that, uh, put some put something down in there. It's an interesting way to capture some of the equity uh, in your home. But the downside, yeah, there's some downs. The downside is the way it works is when you pass. Let's say it's a person, they have a spouse, or like let's say it's your older parents. You can set it up that when one dies, the other one gets to stay in the house throughout their life. Uh, and then when they die, the family can either pay the loan back, or the bank just sells the property, get their money. So there's if the person or couple doesn't have any kids or family, then what do they care if they're both dead? What do they care what happens to it? So they get to have the money, and at some point in the future, the bank gets the property. So there's different ways you can play that. So, if someone's listening, they also think they're sitting at the top of this market, then they should go to that find a financial planner and talk to a financial planner, and the financial planner can tell you, faster than maybe we can talk about it here. And a financial planner can give you information about if that's a good risk for your situation. So I would just hate for our people to miss out on this opportunity, you know, just because we didn't know.
We should. I think we should always be buying land. We should always be buying real estate. We should always be acquiring those assets, regardless, because they're always going to pay off in the end. Real estate historically has been the safest, smartest investments that people can get involved in. One of the safest investments any one of our species can get involved in. It's just how it is across the world.
Yeah, generally that's true, but there are exceptions, and this is one of those exceptional times.
I don't think so.
So
I disagree.
that's
I
our
disagree.
fundamental difference.
I
That one,
disagree.
that
But
note,
anyway,
I'll move on, because that one, now that's what I wanted to get you to say, because now I know the nature of our disconnect. So I will be.
there's no disconnect.
No, no,
It's
it's
just
not.
the
It's
truth.
not. It's just that's what makes a market. We all got to have different opinions, because that allows us people in the marketplace to see value differently, and that facilitates a trade. So
Well, I
that's
hear you.
all. That's all great. I'm just.
I,
Uh,
I'm with you. I'm just one who was actively involved in this right now.
oh yeah, yeah. I'm very aware that my opinion is a minority opinion. I'm very, very aware of that, and I know the burden is on me to prove my point, and I will. You know, so I accept that challenge. Okay.
To the bang, to the bang.
Okay. Now, what we're looking at here, can everybody see this USO?
Yes.
Okay, this is US oil. Um, what we have here is high in October 2018, and we have a retrace. Let's see, this the bottom. I got using my Fibonacci extension tool. I have the bottom at 100. Retrace a typical Fibonacci retraces around 60. That's roughly 62%. You can see, of course, 38 plus 62 is 100. So just kind of, do the math backwards. And so that would be a typical Fibonacci retrace in the area of this line right here. And what happened? The price went up to that typical area, just a little above it. And we're sitting right on the support, right on the support. And we're looking at a daily chart right now. And we can also see that the stochastic, drop broke the line right as the price did, just to show even a little clearer what's going on. I'm going to now we're looking at a weekly chart. What the heck is, I don't know. Okay. The stochastic, weekly stochastic, pretty clean here. It shows that we flipped. The oil flipped. That's why you see that big line here. If it continues to fall, it's going to bring this whole thing down. The question will be, will we make a new low? We won't know that. But this weakness in oil should correspond with dollar. Let me take a look at the dollar, since a dollar will. What would I be without looking at the US dollar, the most important currency in the world?
Hey, I'm a little tired. I'm hop off.
Okay. All right, bro.
I'll go.
All right.
Okay. What we got here is this thing just keeps on. First of all, it's stochastic because it's still momentum higher. We're looking at the weekly chart. The high is back here in December of 2016. So we're, it'll be 3 years ago this December coming, the high. The point is, we broke above this high here, which we hadn't been in this area since like May of 2017, almost 2 years ago. But all this talk on the news, they're not talking about this. This is what's significant. This rise in this dollar, and it's going to, and I am of the opinion that it's going to rise and take this high out. We have a significant way higher to go. And I've been saying this for the past year on the brain trust. And this break above this high proves that I've been right the whole time. Okay. And it comes from my long-term perspective of Elliott wave theory. Okay. And it's in my channel. I think it's the first video. I don't know if I break down the dollar, but I break down the S&P and Dow for sure. But we got higher to go. And so this strength in the dollar is putting negative pressure on oil. The same thing for gold. Let me see what I can see on. Let me just pull up the good old GLD. This is an ETF for gold. There's more money in this ETF for gold than any other gold symbol. Let's see. Yeah, so yeah, it broke. Now we had an ascending triangle here, and it broke out of it, and and that strength in the dollar is gonna cause this thing to continue to fall. Okay, so we're just gonna move on. I'm not gonna spend too much. What we're looking at now is the S&P 500, and today the S&P 500 close. What is this? Is this the first? Let me get this straight. Okay, good. Because there's a SPY is the ETF, and it did not necessarily make a new high. like they were saying in the news, but I'll use the symbol that the news is using. Okay, so this is the price high. Now the news report is they said today the S&P 500 had a let me go to the daily, I guess, instead of the weekly. I'll come back. It had a all-time high, closed on an all-time high. So let's look in the information box. Okay, you see the first of all, the high is the absolute highest price of the day, and that's 29.39.88. Okay, the close price was the 4 p.m. price, 29.39.88. Okay, wow. So it closed at the high, so that suggested it should go higher. That would be strange if it didn't right on that day, but that still means nothing. To me, it's just we just way too overboard. Okay, what we got here? The high here is 29.40.91. So and the close back in September 2018 was 29.29.67. So today we had the all-time close, our highest close for the S&P, but it was not the all-time highest price. All-time highest price was still back in September of 2018. So why the news makes, they that to me, that kind of cheerleading is annoying. To me, it's just annoying. So what we have here is the stochastic here and the MACD here. And we are in the overbought territory. 100 is the highest on the scale. We're already at 95, and we're looking on a weekly chart. Okay. And the MACD, these are blue bars here, is showing you the distance between these two lines. So the fact that these bars is getting shorter over time is showing you that these lines are moving closer together. So it's running out of momentum, as it should, with us being as overbought as we are. Does that mean that it can't go higher? No, it doesn't mean that it can't go higher. It means that we are overdue for a pullback. Now, when that pullback comes, it's at that point we'll see how far it declines. Do we make a new low? We'll see when it happens. But for me, this is not a good point, a good risk to be coming into this market if you're not in it. I've had a lot of my friends get out. Get out. It's just not. It's just if you've made money, you've been making money since 2009. You've been riding this out. Why even? I'm telling my friends, why even play this game? Okay, you went from overbought to oversold. Now you're even higher on the stochastic oscillator now than you were here. So to be at this point of April 26th, 2019, and to be in a mood or a betting, quote, basically, quote, betting that it goes higher, I'm like, why? Why? Take your money. I'm telling my friends, you can do what you want, consult your own financial advisor. I tell my friends and family, get out, take your money, go sit down. Wait until the price gets oversold, and then we'll see how low it drops. If it drops below here, then you definitely want to make sure that you are have a negative bias if we make a lower low. Now, we made a lower low here. Now, if we make a higher high by taking this out, that would be bullish. That would be a bullish move, that we would have made a new low and then turn around and made a higher high. But if that happens, we'll see. And when we have the correction to make the usual journey from overbought to oversold, we'll see. what that is. But we are way overdue in this market for a correction. And on the monthly, you can see the momentum is going down, and the price has still been going up. And you see, and that's not a good sign. So real money is not really supporting these prices. So it's not just dollar will that's not optimistic about the stock market or the S&P 500 at this price point. It's showing you here on the monthly chart. The momentum is showing you here that traders are losing interest in buying at these levels. And usually, when you see this this is called a divergence, where the momentum goes one direction and the price goes another. Usually price catches up or follows momentum. Momentum starts to move opposite price, and usually price catches up and moves in the direction of momentum. Now, this could be pretty scary. So there's let me see what quarterly. That's why I like this site, because most sites don't give you a quarterly view. Okay. Let's see. So we got a quarterly view. Of course, that's that's 3 months. So we don't have a crossover here, and it's also going down. So when you look at it on a monthly chart or a quarterly chart, on both longer time frames, you see momentum trending down. Price is going higher. So you have fewer people participating in the trade in the market, and that small or diminished number is bidding the price higher and higher. That I don't want to be one of those people bidding the price higher and higher. I'd rather wait for a bargain price, and that means waiting for price to catch up with momentum, meaning fall, and see where we stand at that point. See if we made a lower low or not. If we make a lower low, then I will be of the opinion that we're going to continue to make lower lows and lower highs. And at that point, the issue will be what's the best way to either short this or rotate into other sectors. And I've identified one that I'm pretty certain is going to be a winner, and that is utilities. Okay, and so there's always some industry somewhere usually is rising. It's not, it's going to be something unsexy like groceries, maybe food commodities, like I said, utilities, guns and ammo, boring cleaning products, Arm and Hammer, baking soda, Church and Dwight. I think that's that company. So
let me ask you very
ahead.
quickly.
Yes.
You think utilities? You're looking at it from a more long term investment play, or what
No,
type of
just
what
a
are you looking for?
hideout. Just a hideout spot. If this market
Mm.
flips like I think it's going to do,
In
then
what time frame are you thinking this market's going to flip?
man, we're looking at this on a weekly basis. This thing can happen any moment. We're already overdue now, and we're already against this momentum. So I'm saying I don't stay in and wait for court disaster. Like I would put a trend line on it like this, and if it broke it, or broke these lows here, especially like I would be out. Me, I'm out. I tell my friends already get out. They've already been riding this since 2009. They made a lot of money. I especially told all my family and friends who are retired, get out. They're not young enough to survive. Uh, if they're wrong, if they're long this market and the market drops, they're too old to recover from that. If the market keeps going higher another 10%, so what?
What, what do you see from the leading and lagging economic indicators?
Ask a fundamental person. I'm just strictly from the charts. I'm just
Okay.
looking at the way the money, this momentum indicator, these and Fibonacci extensions and Elliott wave theory about price movements. That's exact. I strictly go on that.
All
And
right.
now I'm saying now my overall pessimistic view is led by Elliott wave theory, and you can Google. I think it's called the Grand Super Cycle. You can look at that kind of information. Now, so I'm already biased in that way. I admit that. Now,
All right.
let me get this
No,
point
this
out.
is last thing I just
Hold
want to ask
on. Let me get
about
this.
interest rates,
Hold on.
Fed funds rate.
Hold on. Let me get this out. Now, when I see this momentum backing up my longer term, this divergence between momentum and price backing up my longer term view, then that emboldens me that my longer term thesis is looking good. Now, about I don't use interest rates and things like that to guide my decision. I'm a technical purist, strictly from the charts, because in my experience, the charts move first, and then those other indicators catch up to what the price action is on the charts. So that is my experience. What happened? You can research
That
what happened in 2008.
that's your method, right? All right. Okay. I hear you in your method.
Yeah.
Fair enough.
Yeah. So, but here's the thing: I'm live on YouTube, and this is going to be recorded, and everybody will be able to check and clown me. You know, if when this thing breaks, I didn't say if. When this thing breaks, you're going to have all of your fundamental data catch up to the charts. It's going to get drastically negative to corroborate what the price action is showing.
Well, there's definitely going to be a correction at some point in time in the future. There's no question about it. It's just a question when,
When correct.
and when you time yourself to get out. I mean, I myself, I tend to use a lot of other market indicators leading and lagging economic. I look very heavily at the Fed funds rate as opposed to any other rate that's out there to really determine, the growth of the market, the shrinking of the market, and so forth, and how that
What
affects stocks and so forth.
make
That's it.
what would make me change my tune? What would make me change my
Well,
tune?
I wouldn't say for you to change your tune at all. I'd
No.
say,
I'm just speaking strictly from a technical standpoint. From what would technically make me uh, take the opinion that the decline is coming, but not like really soon. That what would have to happen to make me do that is
I,
now hold on. Let
go
me.
ahead, go ahead. Say what you're saying. I'm not interrupting. Go ahead.
What would have to change to make me become bullish, at least in the short to intermediate term, is I'd have to uh, see the momentum move from overbought to oversold, and then begin to rise again without making a new low. If I saw that on this weekly chart, if I saw that, then I would be inclined to get long the market and have a tight stop, below whatever that price low is, and ride it up at that point. But for now, I think what we have to lose outweighs what we have to gain. So that's just that. But we're gonna see. I don't think we're that far. Now, here we are about Bitcoin. Let's see. Last week we talked about Bitcoin, and I said it's just gonna thin black line. I said last week that I don't care what Bitcoin does. Tell me when Bitcoin crosses above this support that was violated. Until it crosses above this support here, I don't care. It's all, it's just not noteworthy to me. Okay. So what we got here, Bitcoin got here, violated the line. All right. Definitely got momentum going south. We're on a daily chart. Let's go to a weekly chart. Okay. We went from oversold to overbought. We're at 81 level on the weekly chart, stochastic. We have not flipped yet, but we're getting closer. And it's already starting to dive. So I feel good about my position. But we still, technically, I'll say, until we break below these levels here, these lows here, it's still kind of anybody's game. I can't say that for certain right now. It can't. It's not likely to turn around and go higher. Okay, so we'll see next week. But this move today was this the 26th? Yes, this move today was pretty nasty. This one move today took took about back to April 16th. One move, just one day, back to April 16th. Yeah, the last time it was this price was April the 16th. One day. So what do you think it can happen? Shit, Wednesday it could be down here. So we'll see. I do not believe that Bitcoin has found the bottom. The next level is I will do a video about that. But right now I'm looking at around the 1500 level. I'm looking at around the 1500 level. We'll see what it looks like when we get there. I've seen people calling for lower than that. I don't know about that. I don't know about that. There's an interesting level, a gap, like a floor between. It's right in this area. It's like there was a prior. There's this support, and that's this resistance, and that support. And so right in that window, the last time I was messing with my Fibonacci tool, it got me right in, it fell right in that window. Let me see. It brought the price. I'm trying to see this price. Yeah, so like around 1500 ish. So it put me right in that area, and that a lot of times prices will fall right between like a area where there was a support and a resistance, and we talking 1500 is a long way from 2000, 20,000. That would be what, like what do we talk about, like an 85% decrease? That's pretty nasty. I would be shocked if we went below that. But I've heard people calling for Bitcoin 1000, and I can't say that I really see that yet. So I'm thinking more like 1500. But I'm gonna now that I have these clearer highs in, I'm gonna do some more studies. I'm gonna do a video later, calling with a better call about Bitcoin, with something more intermediate, maybe even before 1500, to give us a clue. Um, we're likely to go below here, come back up, test this level, and fall. So we're going to likely have an A, B, C pattern. So we're going to fall below this low. Come somewhere here. I'll have a better target later. Then we're going to do the B wave. We're going to come up to this area, in this general area of this, and we're going to fail, just like we failed here. We're going to fail here next. Then we're going to have the C wave and continue falling. So that's my theory, according to Elliott wave theory, because retraces are ABC patterns, and I believe we have another mini ABC pattern here to get us in the 1500 area. Like I said, some people are calling for 1000, some people going lower than that. But as pessimistic as I've been about Bitcoin, I can't see that yet, quite yet. But I'll have something more definitive after I do some more chart work with these new levels. Is there something in particular, Mike? Anybody want to look at? Hello, hello.
No, man, do your thing.
No, no. I mean, I'm done. If unless somebody wants to see something in particular.
No, no, no.
Well, I was gonna say Walmart and maybe Home Depot.
Okay. Let me see. Walmart. Home Depot. What's that? WMT. Daily. Well, we see it's over. We see Walmart's over bought on a daily momentum coming down, but we need to get a better. I just want to see in general. I haven't looked at Walmart in a long time. Okay, so it's been rolling since what's this 2016. Man, this thing has been going a while. I mean, good Lord. Walmart been rolling. Man. It seems like it can go even higher. I'm looking at this, and again, I'm an Elliott Wave trader. I don't see no five. I don't see nothing. Looks like no completed five count here. So I think this can go higher. So the monthly is suggesting that it could. I'm looking at it in terms of momentum for the monthly, it's suggesting that it could. So we're only at 59, and so we're not even nowhere near overbought on the monthly. Now we might see it might be on the weekly though. We are almost, 73. We're not, no, 80. I guess it would be 80. So we are in that area, but it hasn't flipped. So it hasn't flipped. So as you see, it can stay in that area for a while. So this looks like it can go. It can go some more. I wouldn't run from this.
The next one was Home Depot.
Yeah. Now I I could go a couple of days and wait for it to come down to the over sold area. Maybe it's got a little bit more to go in terms of dropping a little bit, and I doubt it's going to make a lower low. But that would be something interesting to watch for this week coming up if Walmart makes a lower low. That would be encouraging if it went to over sold status without making a lower low, and that would be a good, could be a good point to get back in. Okay, so you said Home Depot. What's that? HD. Okay. Yeah, I don't like going against this momentum. And you see it confirmed right there. You can even put an imaginary line there. It looks like it violated the line. So I would be looking with this support in mind that maybe the price could come down to this area. So I would be, again, same thing. I would wait. So on the daily chart, I'd wait and see if it goes down to this oversold area. It's probably going to come in this 195 area. I just check it out. Now it might not. Let's see. It might not take that long for this to happen. So Home Depot. Let me look at this on a bigger scale. But Home Depot is in that area. Oh wow. Okay. Okay. No, this is concerning. A possible reverse head and shoulders. Okay, that would be the left shoulder. I can't. Let me move. I gotta put this. Information box is annoying. Okay, so we got the left shoulder, the right shoulder, the head, and we are coming down. Now, if this was the peak, since retraces are ABC patterns, that looks like it could be. Let me look at it on a longer time frame. And on the weekly chart, we have not flipped momentum, but we are at 89. So it will be something I would watch. So now, we just got finished looking at the funky S&P 500 that I don't trust. Now we got a head and shoulders pattern for Home Depot. This I wouldn't be buying. Let me put it up like that. I definitely wouldn't be buying. And so here we got a high around January. I'm sorry, not a high, a left shoulder around January of 2018. Remember my mistake, my false call in the high of, I believe it was the S&P. That was also around January of 2018. So this thing is looking a lot like it's mirroring the S&P. I would say the safest way I would do this, now that I've seen that reverse head and shoulders, is I will put me a support line here. If that price violated that line, I'm out. I would, actually, I think the safest way to do it is play this on the short side now, and stay short until the price reverses and proves you wrong. So I would start betting against this now. Okay, and because this is a weekly chart, and the low here was 203.40, the low here was 203.34. So we did make a lower low on this candlestick on this current week. We did make a lower low. So not only did we make this 207.78 high, 208.29. So we made it's an outside move. So we made a higher high and a lower low. Okay, so that and you can see clearly that if there's a trend line you have here, it broke it. So we may have a lower low. That would change my bias to make me bet against this. I'm already looking at head and shoulders pattern. We're already overbought on a weekly chart. I already biased against the S&P 500. It's in the housing sector, which I already said I wouldn't touch it with your money. Okay, because that's one of those sectors that's going to get punished in this downturn. I know people like real estate, but it's a bad time to own real estate, and I think this is it. Okay. Now we got on the monthly, you got a little spot here, a little cross there, but we'll see how long, how that goes. But yeah, I'm not liking this. I would say I'm decidedly bearish on this. On the quarterly chart, you have the momentum going down, just like we saw on the S&P 500 price, still, moving up or sideways at best. Okay, I guess since this is a high, I can't really say the price is moving higher. I can say that it is going sideways. but the momentum on the quarterly is down. So just like we saw in the S&P 500, the marketplace is telling you that they don't have no love for this company. So, get emotions out of it. You have divergence here. And at this key level in the market where a lot of us Elliott wave traders have been pointing to this area with going back years. We didn't just come up with this yesterday. We were looking at this price level years ago, saying that when the S&P and Dow got to these price levels that we would have a correction. Okay, we did our price projection years ago. And so here we are, the prices at these levels, and we're seeing funky stuff and we're seeing divergence. That's good enough for us. Now, for fundamental traders, they need more data. That's what makes a market. That's that's how I get paid. I don't want fundamental, believe me, I don't want fundamental traders to stop doing what they do. That's how I get paid. I take their money. Okay. So that's it, unless you got something else.
No, that's it. That's all we have. We did have a question from Rainy Woman, but she won't be able to ask it tonight. She'll probably have to come back on another night.
Mm-hmm.
And please hit the like button, share the video, and keep in mind that we are not certified financial planners. If you want a certified financial planner, please go to cfp.net and look up one in your area. Also, keep in mind, tomorrow night we do have this first the first spring Black IT Summit. So we will be covering everything that you need to know for going into 2019 and information technology, careers aspects, certifications, mentorship, open mic, as well as article discussion as well. So we'll be doing that. And then we have Sunday, we have our cannabis hangout with Business, Wealth, and Power, Anti-Gravity, and Complex Design. So make sure you stay tuned for that as well and hit that notification bell so that you can get all the updates. Right, so you can get all the updates necessary from the Black Brain Trust. And keep in mind that we are also Manosphere 3.0 compliant, meaning that we are providing self-improvement. So we are not into all the other content that does not involve the advancement or the best interests of Black men. So that's what we are promoting here tonight. We established this last Saturday on our anniversary hangout. If you have not seen that, you should go into our archives on April 20th and check that out. So Manosphere 3.0 compliant. So we're third wave Manosphere.
I like the sound of that.
Anybody claiming to be Manosphere, make sure you check their the versioning software that they're running, because if it's not 3.0, it's not authentic. With that being said, thank you all for joining us and have a good night.